Thanks, Michael. My name's John Hartman, and I am the Chief Investment Officer for Caliber Companies, headquartered in Scottsdale. We're a middle market alternative asset manager. We invest primarily in the Southwest, Colorado, Texas, Arizona, New Mexico. We have really four different strategies or four different buckets we allocate capital to. One is the Opportunity Zone fund that we run, which is our largest fund. We have a development fund, we have a core plus fund, and we have a fixed income fund. So that's really sort of the buckets we invest through.
Great, thank you. Anthony?
Yeah, thanks, Mike. Yeah, so I represent Group RMC. We're essentially a real estate co-investment group. So why that's an important kind of distinction is because we look for deals that we want to acquire. We'll put 10 to 15% on average of our own equity in every deal. And then we partner up with like-minded partners. And we do this because it allows us to pool our money together. It allows us to get a certain level of capacity and go after much larger deals where the pricing and the going in metrics are a lot more attractive because of the ability to buy and the ability to have that firepower to go in with a group of like-minded partners. We have a GPLP structure, although we invest as limited partnerships in absolutely every single deal. And then other families and investors can come in and invest alongside us as LPs. Investors have two options of co-investing. We offer deal by deal, so it's almost like each property, each acquisition has its own SPV, and you essentially have its own vintage. Or we also have a master limited partnership, which is more of an evergreen structure that allows you to co-invest. Everybody's in the same ownership level, and we focus our efforts mostly in Middle America, but we're largely value driven. So where the cost basis makes sense, that the cash flow makes sense, we're going to be looking at those assets. We typically are looking at a 7 to 10 cap range. Quietly over the years, we've developed a pretty big footprint across Kansas City, Columbus, Memphis, a big chunk in Illinois, as well as suburbs of Illinois. And that's we're about 21 million square feet, 2.5 billion assets under management today.
Thank you very much. So let's get into the elephant in the room right out the gate, what people want to hear about, which is this whole dynamic between work from home and go into the office. The issue of employers bringing people back to the office, forcing them back, and employees saying, hey, I'm not going to do it. So let's talk about that dynamic. I'm going to start with John. What are you seeing right now?
Well, Scottsdale or in Arizona in general, we haven't had a mask mandate for a real long time. So our office is really 75, 80% back. Most places around here people are back to work. We're not seeing as much remote work here as we used to. That being said, there still is a lot going on remotely in our Colorado and Texas areas for whatever reason. So I don't know. It's an interesting dynamic, right? I mean, is it going to affect sort of the way that offices have been built out in the past? I mean, are we going to go backwards to sort of large private offices away from the open floor plate? I don't know. I think it's still a little bit of a falling knife, honestly.
Okay. Anthony, what are you guys seeing at Group RMC?
Yeah, I mean, so I definitely think that the added flexibility of kind of these Zooms and the virtual stuff, I think is here to stay, and I think it's great. But looking at what's actually happening, there's a couple of ways to look at it. So if you look at it like kind of what's happening from employers' perspective, there's a lot of it's a bit of a frothy subject, working from home versus forcing your employees to go back to work. It's a tough, it's a very you got to be careful how you address it, because I think you might scare off some of your employees. But I think employers really want their staff back in the office. So I think that's going to be the driving factor, is really, they want them back. And some institutions, some groups, some large companies now are starting to make them come back 5 days a week. And I think that's going to be the norm moving forward. with that added ability to just be flexible. So when you look at it from a usage perspective, I mean, we're seeing our usage like John was saying, like pretty high up there. We're like in the 80s, 90s%, depending on which market you're looking at. But the usage is back. And then the other thing, so from the usage perspective, I think it's there. And then the other side of this is also just kind of looking at what's happening in the commercial, like specifically office. I mean, you're seeing Google, I think they just bought like something like 2.2 billion in office. Like office deals are being snapped up. There's not many deals that we're finding. So in terms of, from an investment perspective, I think that's going to be good. And also from a usage perspective, including the fact that people are going to be working from home a little bit more or virtually, I think that there's still going to be a demand there, for office space.
All right, next question. And I want to get the hard stuff out of the way first. Are we going into a recession? And how does a recession affect the office market?
Look, I think we're probably already in, but I think, unless something changes, third, fourth quarter, first quarter next year, we're going to be in recession. And, how does that affect the real estate market? To be determined. I mean, we're forging ahead with projects. I mean, we're developers, we're buyers. Once we're under construction, we're going to keep going. We're not going to stop. So maybe it opens up the opportunity to buy more cheaply. That would be, we wouldn't mind seeing some distress in the market. Everything is so expensive. Construction costs are going up so quickly that it'd be nice to be able to get back to our roots, which is buying sort of distress and value add.
Yeah, we had such a small window to that point. The pandemic was that we bought probably the best deals that we've ever got. We bought about 5 million square feet of new assets, part in Jacksonville, part in Houston, suburbs of Chicago, at ridiculously low cost basis. Deals that we hadn't seen in a while, and they've just dried up already. Yeah. So I mean, in terms of opportunity, it's been there's already no more price discovery, which is crazy because it was like, relatively speaking, such a small window. So yeah, and then I mean the recession, it depends on how you look at things. I mean, if you're well diversified and you have a good tenant base and you have good quality tenants, and they're going to keep paying their rent, they're going to stop operating. Like we have FedEx, Microsoft, like large company names, and we're diversified from a business risk perspective as well. So we have maybe 40 different exposure to about 40 different business sectors across 14, more than that, over 2,000 tenants. So it's a question of being diversified. And yeah, maybe you might lose some tenants along the way, but that's the nice thing about real estate. You still own the asset, right? So there may be a lull, but then even if the recession impacts the economy in a certain way, you still own the building. And so you'll always have a chance to bring it back up and create value just by leasing up space, bumping up rents, increasing occupancy, reducing expenses, and so on.
So I really have two questions that I want to ask. I'm not sure which one to ask first, but let's go with. All right. So you guys both feel like we're either in a recession or going into a recession, and that this brings about opportunities that remind you more of normal times than the past couple of years. So how are you preparing yourselves? How are you preparing your firms to be properly positioned that when the opportunities do present themselves, you're able to capture them, and you're not waiting to set up a structure to find the right deals? How are you guys ready to take advantage of what seems like shorter and shorter, recessions?
Well, look, we're raising capital at a very high rate right now, and we're sitting on a lot of cash, so that's sort of where we're going to. We're still investing in opportunities as we see them, and including the building that we're in. We're buying this for what I would consider an exceptionally low cost, and we have plans for redevelopment of this asset. So when we come up with good opportunities, we'll take advantage of them, whether we think we're going into recession or not. we're we're breaking ground on 88,000 square feet of new medical office space, probably here in the next 60 days. We think that market stands up well. But, we're trying to keep as much dry powder on hand as we can to see where things end up.
Yeah, I guess same for us. We do have a lot of cash on hand, and we have a pretty good network of co-investors that are, have certain amount of commitments with us. So we do have a really nice opportunity. It should the opportunity present itself. Just kind of going back to what the opportunity is, I think the interest rate hikes haven't been reflected yet in the prices. So typically when rates go up, the pressure falls on the seller, not the buyer, right? So, but sellers are still selling as if when rates were 6 months ago. And I think that people still have those expectations, and certain groups who are selling think that they're, they're worth this, but really they might have to kind of bring it down a little bit more, just to coincide with what the current market reality is. I think that hasn't happened yet. And I think for us, like the way we see it, I think that's a great thing, because if rates, even if stay the same, because rates is a big part of it, right? Like why the cost of everything is going up and all that. Rates is obviously a big part of it. And I don't think the rate staying at this level is a bad thing. And especially if it allows for our cost basis, our entry point to come down because sellers are adjusting for the higher rates, that's even better for us, because we could control how much cash we put as a down payment. So we could control that cost of debt, right? Whereas, if the sell price is the sell price, that's your cost basis going in. That's what you got to work with for, the rest of your whole period of that asset. Whereas if you get it at a lower cost basis, even if the debt is a little bit higher right now, maybe in 2-3 years might be a good time to refinance. And there could also be an opportunity there, like down the line.
Yeah, I would agree with that. There's a disconnect between buyers and sellers right now.
Yeah.
All right. So the second question I wanted to ask, and this is sort of, I think I chose the right order to ask these, is how do you build into your acquisition process, your valuation process before you get involved with the project, to deal with these uncertainties that come up. Like, so how does your investment strategy manage the risks associated with, let's call it the macro economy that never stops?
Well, that's a great question. I mean, we look at everything deal by deal. We're really in the middle market, call it $5 to $50 million, right? So we're not out buying giant skyscrapers. When we're picking up a building like this, it's 100,000 square feet. We're paying, 19, 20 million bucks for it. We're looking at, the current lease rolls, how many, shadow tenants we have, what we can do to improve the rates and the management, that kind of stuff. And then we're looking at a long-term view, right? We hold everything for at least 5 years. In our opportunity zone fund, sometimes we'll hold for as long as 10. So we're prepared to ride the cycles, really.
Okay. With regards to your structuring, how long do you have your assets for? What's your time horizon?
I think on average, we're holding our assets probably for 5 years or so. Even in the opportunity zone, from time to time, we'll flip those over and reinvest the capital. But I'd say that our average hold time is about 5 years.
Okay, great. All right, Anthony, and how about Group RMC? How do you guys build into the structuring, the acquisition, the due diligence, the valuation of the asset? How do you guys de-risk your acquisitions?
So we're a little bit more longer term. We invest with the idea that we're not planning on selling. We do sell. We're not opposed to selling, but our kind of philosophy has always been to buy from sellers who are selling for non-economic reasons. So you might see more recently the opportunities during COVID were groups that promised a certain level of liquidity to their investors, and they kind of became forced sellers of their assets. So it's not the underlying assets that were distressed, but it was actually the investment structure or the seller that was offloading assets, again, for non-economic reasons. So we come in and we provide that liquidity or that liquidity injection to groups that need that exit. which for us is amazing because we're buying at a much, much more discounted price. So going back to your question, like how do we kind of, de-risk, is when you get in at a low enough cost basis, and you don't really have plans of an exact selling date. Like we will sell. I mean, if the prices make sense, we'll sell. But if you have a low enough cost basis where you're going in metrics, you're already generating like a bunch of free cash flow. Like the one we're closing now, Americana 9, we're generating 6% of immediate cash flow with upside. So, and just through, the free cash from collecting rents, net of paying your debt service and cash reserve, we're able to pay out a 6% distribution to investors. Plus, we're planning a refinance in 4 years. So by 4 years to 5 years down the line, you have almost half your money back just through cash flow without really having to sell. And so it's really about, I guess, making your money on the buy, right? Like that would be how we're mitigating the risk. Yeah. And just, not really worrying about, I mean, like I said, we'll sell it, but it's just more about, okay, well, and like John was saying, like one of the nice things about real estate is that you can create your value, right? Like you're leasing up your space, you're bumping up your rents, you're increasing your occupancy and so on. So your value that you're creating within your portfolio is not so much tied to third-party factors. It's more tied to, your job as a landlord or your job as an operator.
All right. So there's a question that came in. Going forward, it sounds like your acquisition opportunities now are good. That's great for new investments, but what about investments you made pre-COVID at higher bases? How do you see yourself exiting those profitably?
Well, I mean, we're across the board. So we're not just office owners. We own industrial, we own retail, we own apartments, multifamily, all that kind of stuff. So, look, we sell when we're kind of at the top of the market. We just sold, an apartment building that we'd owned for about 6 years at a 2.75 cap rate or something. It was just ridiculous. That they would overpay in such a manner. And then we've got hotels that we got stuck in during COVID that we're pushing into a REIT and we're taking public. So we're always looking for creative ways to exit. I think some of that is that, we've been looking to push some of our assets into DSTs and retain the management as well. So, we're always trying to be creative on the exit and still retain, management and control of the asset if we can.
Yeah, we're a little bit more specific in our market. So we're not, we've done multi-res in the past, but since 2011, we've pretty much only been focusing on office. So right now our current portfolio is only office. And I can speak to like the pre-pandemic. One of the things about kind of the markets that we're in, we never saw the top-down cap rate compression happening like you might have seen in New York or, the more momentum-driven markets where there's two ways that you see cap rate compression. It's either the landlord's kind of creating that value from the bottom up, or you just see a bunch of money coming into any given markets, which is driving up bids, which means that, cap rates are going down. We never really saw that in our markets. And a lot of our, I guess, appraisals or our evaluations are based on the fundamentals. So who are your tenants? What's your occupancy at? What's your NOI? The weighted average lease term and all. So all those kind of get baked into the appraisal and the evaluations of the building. So when we reassess, we reassess our assets at least once a year, at the bare minimum once a year. And so when those assessments came in, we were relatively flat even through COVID because it's largely driven by NOI. So if NOI remained relatively flat, our appraisals remain relatively flat. And that kind of ties into the fact that we're longer term. We're not really looking at exiting or anything like that. We're much more of a cash flow play and just longer term hold. And again, going back to the distributions and the refinancing. How would we're not planning on exiting any of those regardless of COVID or not. But if I look at the appraisals and what they're worth from third party, Colliers, CBRE, Cushman's and so on, we've remained relatively flat. And that, again, ties back into where's our value creation coming from? It's coming from leasing up space. So the pandemic, fortunately, we did really well. Like our portfolio was very resilient. But the kind of negative side was we weren't able to create much value because we weren't able to show space. we weren't able to finish. A lot of our lobby renovations and projects kind of got delayed because of COVID. So all that kind of value creation that we would have done for 2 years was pretty slow, right? But now we're back, and so things are opened up again. It's great to see. We just finished a project in Cincinnati, or rather a lobby renovation in Cincinnati, and that's driving up rents and so on. So now we're back to seeing that, and again, that's where we're creating the value, not necessarily exiting.
Yeah, it was surprising how quickly that things just turned around. I was amazed how quickly things took off, and we were back to running at full speed. I was not prepared. I thought we'd have more time.
That's a good thing. It's good to be back, though.
Yes, it is.
So, Anthony, this is a question for you. Group RMC has been mainly in the Midwest. You guys have transitioned into some new markets. Can you explain a little bit as to why and how do you see the risk reward profile in these new markets different than the traditional Midwest?
Yeah, so I mean, again, organically, we kind of developed our footprint in the Midwest because that's just simply where we were finding the deals. So we're value driven. If I can find a 10 cap in multi-res in Manhattan, we'll look at it for sure, right? But you're probably not going to get that, right? So again, we're value driven. So wherever we can find the best deals. I mean, hospitality, we don't have a ton of experience in. Kind of there's just a shorter, essentially the quicker turnarounds are shorter. Like we don't have a lot of experience there, but multi-res, industrial, and office, if we can find opportunities, we'll go. It's just where we've been finding opportunities has largely been kind of in office in US, in Middle America. But, for instance, we just were able to do our first deal in Houston, Texas. And Houston, prior to the pandemic, we never had really a window, and so we acquired 5718 Westheimer. We acquired that from UBS, who had some, they had to meet some liquidity demands, and they have to offload some assets, which was great for us. We were able to get in a really attractive cost basis. And we acquired this at 62% occupancy, so they were just in full swing, like. They were getting a bunch of leasing momentum. They signed about 100,000 square feet on a 500,000 square foot building over just a year before we bought it. So we were getting in at an amazing, we were getting all the momentum from the lease that was happening. But at 62% occupancy, we're still cash flow positive. We're distributing 2%
nice deal.
On this deal. And that again is a function of the cost basis. So again, it's just a question of if you make your money on the buy, you can absorb a lot of headwinds along the way and still do okay.
Awesome. All right, John, how about you? Has your the locations that you're investing in, have they changed at all?
Not really. As I said, we're really in the Southwest, and I consider us a middle market buyer. And so we don't really parachute in and buy large projects. If we're going to enter a market, we're going to put boots on the ground in that market. So right now we're in Arizona, we're in Texas, we're in Colorado. We've been looking at some deals in New Mexico and other areas, but for us to enter a market, we have to have a presence, and that's the way we make our expansion.
So do you guys do all your own property management, or is that subbed out to outside?
We do none of our property management. We were in that business and we got out. We sold the property management business. It's just nobody ever calls you with good news when you're in the property management business.
Yeah. Exactly. We just outsource everything. CPG, Colliers, whatever. But you can't even compete with those guys, right? They just got they have the scale and.
Yeah, you gotta have so many millions and millions of square feet under management to be able to compress the costs and make it reasonable nowadays.
Yeah. When you say boots on the ground, what do you mean by boots on the ground in those markets?
Well, we went into Texas recently in College Station because we set up a private account down there. We've actually, the money came from Texas and they wanted to invest in Texas. So we went down there, we found some projects. We literally leased some space adjacent to our private account and are moving in. And then we put our development team and our construction managers, acquisition guys down there. And Usually a couple of our finance guys as well, but, small kind of satellite office where we'll invest capital alongside other developers as co-GP, but we're always putting our construction managers and our developers on the site as part of the deal because, we come in as we sign the completion guarantees and all that kind of stuff. So if the deal goes pear-shaped, we want to be able to take it over and make sure it gets finished. And that's from a TI job all the way up to a new build.
Gotcha. So with regards to some of the dynamics in construction, with regards to cost and labor, how are you guys managing? How are you managing that?
That's been a real problem. I mean, we had to go and buy all of the lumber for a job we were doing ahead of time, and then have it at the yard. It saved us probably 25% on cost rather than sort of buying it over time. It's been a problem both from the debt standpoint and from the timing standpoint, right? It's every time we get ready to pull a construction loan, we've got construction prices have gone up 25% since we started the pro forma, and we're going backwards trying to add more equity into the deal. That being said, we're seeing the rents go up just as quickly as well. So we're moving away from, we have a very robust development pipeline. We're finishing out that. I'm moving really more, I think, into core and build to suit over the next kind of year or two, just as sort of a safety measure. We've got a couple of large tenants that we would consider doing some build to suits on their corporate credit. So, but yeah, I wish I could tell you there's a great solution to it. There isn't. It's a difficult prospect.
All right, so we're in the recession, maybe, maybe not.
Maybe.
Right. The Fed is going to raise rates while we're in a recession, which seems a little bit odd. How do you see that, like, handling those inflationary pressures inside of building materials and labor? Is that something that is going to fix some of these issues, or is it just so, like, what's the word I'm looking for? Uneven, that the costs of labor are going to just keep going up, even into an economic contraction.
Yeah, I've yet to see construction ever get cheaper. I mean, from all the time I've been doing this, it never gets cheaper. Maybe we get a better workforce. Maybe we stabilize the cost pressures on the materials and that kind of thing through a recession. I mean, there's kind of two views on what's going to happen with interest rates. They're going to keep going up, and we're going to end up in the 70s, or with all the U.S. Treasury bonds that we have out there, that the government's going to have to look back and say we can't afford to pay the debt, and we're going to have to drag these interest rates back down. So I don't have a crystal ball, but I'm kind of hoping for the latter.
Fair enough. What does this do to replacement value inside of the group RMC's market? Like, how does that affect replacement value, these accelerating construction costs and labor costs? Is one of the factors you guys focus on have anything to do with replacement?
Well, we look at replacement costs because we want to, and then mind you, we're in markets where there hasn't been a whole lot of new construction in the past 10, 15 years. So we do look at replacement costs because we want to know, okay, well, what's our when can new construction happen, and when, because that's essentially a risk to new supply coming on and potentially stealing our tenants, right? Like that's so we do look at replacement costs. I think a rising rate is obviously going to kind of increase that cushion. Like we're typically at the cost basis that we're acquiring, we're in the 50 to 60% discount to replacement cost. That's on average, that's on average, or some a little bit more, some a little bit higher, but on average, that's kind of our range. And obviously, if it's just more expensive, if just cost of building is more expensive, obviously that's going to go up, right? The thing is, the flip side, I think we might actually start seeing a little bit more competition as well, because if cost of labor, cost of capital, everything is going up, you might find it cheaper to buy existing, and that's more kind of our bread and butter. We're not developers, right? We buy existing. And so we might start seeing a little bit more, I guess, maybe competition on the bidding side if rates stay as is, if they don't go back down.
Do you guys, either of you, have plans to set up like distressed opportunities funds?
Well, we started out in distress. This company was kind of built on buying in distress, and I think that I'm basically turning over all of our funds. We'll have all new vintage funds this year for our core strategies, and then we're looking at adding some offshoot strategies. But it would really depend on where the market is. I think our existing funds could take advantage of that distress as is and where is.
We looked at there was an opportunity, and we're still monitoring it fairly closely, is setting up kind of like a pipe financing structure. There's oftentimes you hear about REITs having like issues keeping up with distributions and so on. So sometimes there's some good opportunity there that you could essentially take one private. So there is I can't really share the name of it, but there is something that we're working on that we're looking to raise a good amount of capital for, and it would essentially be for a preferred financing to take over ownership of a REIT with our co-investors. Yeah. So it got a little bit more exposed during the pandemic. Now it's kind of back, but I think it's having problems keeping up with its distribution payments. So as soon as they cut distributions, that might be a really good kind of entry point for us.
There's a lot of REITs with legacy issues like that right now, where they're cutting their distributions and that kind of stuff.
Oh yeah.
Yeah. So that's a trend that's happening on a broad basis.
Well, I mean, I'm speaking primarily to the hospitality sector, and one of the reasons we think that we could take the 1.2, 1.3 billion in hotels public is because we'll clean up our legacy issues with the IPO proceeds, and we'll come out of the box with a 4 to 5% dividend in what is a very small sector of the REIT market. So having a performing dividend, we think, and all of our legacy issues cleaned up gives us a sort of step forward within that marketplace.
Very nice. Are either of you doing anything in the medical space?
Yeah, we're doing an 80-acre medical campus as a co-invest with a group out of Chicago called Health Development Partners, and we're also doing a number of behavioral health build-to-suits. Yeah, I think we're going to build like 24 behavioral health hospitals on a build-to-suit basis.
Okay, and what about Group RMC?
No, we haven't looked at medical. Although I do get a lot of questions about it. It's not something that we've done. We are potentially looking at doing some land leasing deals, but that's a little bit further down the line. So that's something that we're looking at, but no, not medical.
Nothing in the medical space.
No.
All right. So what about these larger floor plans? What is your opinion on that? How does the layouts change? Like what are some of the trends happening that you're seeing from tenants? How do you see them changing the traditional floor plans of the office to the way things are headed now?
Well, I can just say simply, we're building out a lot more individual office spaces than we were in the past. There's the open floor plan has changed, but again, we're not on these giant floor plates. We build probably, we're in garden office primarily and the stuff that we own. So Anthony's probably got a better take on that than I do.
I think we're heading away from that. So I think what's going to be important moving forward is to have reasons to be at the office, right? Like that's the most important thing. It's because there could be a pull-push thing, right? It could be like employers saying that you got to go back, and then it could be like, you should come back because look, this is the right way to do it. So I think that's going to be more to adapt adapting that, landlords are going to have to do with employers. And so, yeah, the open floor plate, I don't think people want to share like that way anymore. But there's still a lot of things in flux now. So, I mean, we'll see where things are in a little bit. No, we've been doing a little bit more kind of individual as well, like more like kind of individual offices, or at least a little bit bigger kind of square foot areas for the offices.
Yeah, we're in the process of tearing out all the cubes just in our own space here and putting in private offices at this point. So,
yeah.
So you're going to like almost like a private banking model,
like a little bit.
Yeah.
Where the outside of the perimeter of the building is like private offices, and then maybe the inner like floor plan has some administrative space. Or
yeah, that's exactly how we're built out. There's my office is on one side, my admin sits right outside, and we've got an office right across from her.
Yeah.
So some of these, sorry, I didn't mean to cut you off. Go ahead, Anthony.
No, I was just going to say another thing that we're looking at, we've been doing more of recently is smaller office suites. So with shorter lease terms. So you might think of like a Regis or something like that, but it's much more, you have your closed off. It's like, imagine walking into like a lawyer's office and each door is closed, or like a private banker and each door is kind of closed off, but it's all the same company. Well, it would be that, but it wouldn't all be all the same company. Each kind of office would be its own kind of micro suite. And so that's actually been really profitable for us, because it's the rents per square foot are significantly higher because it's shorter term. So it's higher kind of turnaround than what we're typically used to. We're much more used to like the 10-year plus, longer term leases. Whereas this, it could be 6 months to a year. And it's just companies who need a little bit of office space, and then they kind of book their area, and there's a common area where they can share like kind of the boardroom if they want to have like a Zoom room or something like that. But that's actually been really good. We've done it on 2 buildings, and I think we're going to keep doing it. It's been a good business model for us.
So I want to just switch gears quickly. Do either of your firms have exposure to like a WeWork or Regis or some of these shared workspace companies?
We do.
We've got one. Go ahead, Anthony.
No. Go.
I was just saying, we have one deal that we have down in Mason, one of our opportunity zone funds, which is a launch pad that we did a build out for. That it's its own space that we built out for them. But I've never really understood the model. I was actually going to mention to Anthony that I couldn't figure out why WeWork made any money, because frankly, as an office landlord, you could build it out and run it yourself, and you own the building versus this lease model, right? So, but we lease that out to a tenant, they manage it, we don't mess around with it.
Yeah, that's exactly what we never leased. We have Regis, but Regis has a little bit of a different business model. It makes a lot more sense to us. WeWork, I just never really understood the business model, and they call themselves a tech company and all that. So it's just not something that I know, but I mean, like, look, I just don't understand it. We don't understand. Like, I'm not the analyst on our team, but even our the guys who want to write the deals, we're not comfortable. Whenever there's WeWork, we're just we assess the tenant, especially if like it's a big chunk of the building. We'll assess every single tenant, and if we don't understand the business model or what the company is, that's like a red flag for us. And we've had zero WeWork, and we have like 21 million square feet. We've never had WeWork.
Wow, that's amazing. So, are those sort of like funky floor plans a thing of the past, or?
I don't know. We work. Yeah. Well, look, Regis works well. So, I mean, but it's not exactly the same thing, but Regis works pretty well. It was funny. I was watching I think it was Sam Zell who was talking about it. It's like, well, WeWork had the guy who was just last week, like working from Starbucks. and that was his office, or whatever. So now he's paying a lot more expensive to go work there. Is it worth it for him? Because then if things go bad, well, then he'll just go back to Starbucks and he'll cut his rent, and it's super easy for him to do that. So I like, we agree with that. It's like, well, you don't have the buy-in of that tenant, right? Like, he's in and he's out. So we just never liked it.
Yeah, no, I totally agree with that. I mean, I looked at it and said, I don't get it. I don't understand it. So,
got you. So, I know that the local CBRE Richard Ellis office in Miami is, it's got a very interesting floor plan, and it's like this new age blueprint accelerated, but that was built pre-pandemic. So I wonder if they're thinking perhaps they made a mistake on the build out.
Maybe.
I don't know. I prefer the private office. You know, it's easier to get the work done. It's very hard to be out in a bullpen or an open area and get anything done.
Yeah.
You guys should look at the pictures of the CBRE Richard Ellis office in Miami and just take a look at the actual office plan. I mean, it's sort of a lot different than what we're discussing here right now. So without mentioning any names, tell us some interesting stories about, employees and employers and the demands back and forth to the office. We need a little bit of drama from you guys, and don't get anybody in trouble, but share some stories of what's going on in the front lines on that negotiation on that front.
We don't have any stories along those lines. People just sort of naturally came back. I think that, it's for us, there's a lot of mentoring that goes on with the analysts and the associates. And I would see this in law firms too. I talk to the lawyers because we deal with them all the time. It's hard. You can't mentor an associate. You can't teach these guys how to do the business over Zoom, right? So it was sort of like, you either come back or we're going to replace you. It's just that simple.
That's a good drama.
That's exactly what we kept hearing. I mean, especially a lot of our assets are in kind of right to work states, right? Where it's like, no, you better come back. You better come back or we'll just replace you. And yeah. So, even if like I was in New York Tuesday this week, and everybody's back. Like, took me a long time to get up to the bill. Like, it took me 30 minutes to get lunch. I waited in line. Like, everybody's back. Like, so and there are companies who are saying you've got to come back. Like, some well-known companies saying you've got to come back. So, yeah, we'll see how it keeps going. Like I said, I know it's a little bit of like a politically kind of touchy subject. Like, employers can't tell employees to come back. But yeah, we're seeing it. So.
We had very little turnover. Very little turnover getting people back.
Yeah.
That's look, that's interesting, right?
I do have a funny story, actually. I heard of someone who was actually quit his job. Found a new job, but never quit his old job. So he was working from home. He was getting 2 paychecks. And really, like, anyways, that was a funny one. He got caught, but
always a scam out there.
So generational, there's like sort of a tug of war. And I have a friend, I'm not going to mention his name. He says we have a tainted batch, like a whole generation that's been
like that. A tainted batch.
Right? They expect to get paid, but they don't want to necessarily work. And I guess a lot of the stimulus money, a lot of the programs that have happened have caused people to really like take advantage of having 2 jobs at the same time and not having the accountability that one would have if they came back into the office. But like all this free money enabled this tainted batch to like realize, hey, I don't have to work. I should get paid, right? And like, I don't think any of us that are on here today identify with that, but I think that there's a whole generation that does, right?
Well, I think there's some truth to that. Just from personal experience, I've been trying to hire 2 new analysts now for like 4 or 5 months, and just signed an agreement with one kid here day before yesterday. But it's like finding people to work has been a real challenge for us. I don't know how it is where you guys are, but I mean, you literally drive down the street, like help wanted signs in every window. I mean, it's crazy.
Yeah. That's the crazy thing about, like, you're going into a recession, but is it a recession if like you're at full employment, right? Like, how do you look at a recession? Like, you look at a stock market, but everybody's working, everybody's dying for more people to work. So, so I don't know. I don't know what, I mean, I don't know what to make of it. Like, I'm not an economist. Like, I have no idea what to make of that, but yeah, no, but to your point, Mike, there's that, I'm trying to find it. I can't remember exactly what the quote is. It's like, hard times create strong men create good times create weak men, and weak men create bad times. So it's like that.
It's a cycle, yeah.
That's just a cycle. Maybe that's the bad batch right there. That's where I'm trying to find. It's a slogan, but I can't remember who said that.
Yeah, I think we lost some Gen Zs on this last little spin. Like I just noticed the numbers dropped a little bit. We must have flushed out the Gen Zs. They don't want to hear that part of the conversation. But it sounds to me like, even this whole idea of a recession may be overblown.
I mean, that's what I was saying. Like, I don't know, because how can you be like, I think everything is just rippling a lot because of the rise in rates, because there's been so much free money for the past, like, forever. And now, and that's what's been keeping everything up. And now the rates are actually going up, and they're going back to something that maybe is a little bit more, normalized, like pre-2008 would be, let's say, call it a normal, like, interest rate environment. And it's heading back there. But I don't know. I think it's just going to take time for things to, like, prices, and it just, everything is moving now, just because it just happens.
It's really hard to put a dart in the board. It really is.
Can you guys just talk to me a little bit about if you have any like office space conversion stuff going on, like repurposing, different uses? Have you seen anything? Thought about any of that stuff?
Yeah, we're repurposing office into multifamily. This building that we're buying here, our lease is going to spin out in about 3 years, and the goal is to convert this over to apartments. And we do the parking lot in kind of, I won't call it single family for rent, but more like duplex, triplex stuff. So, and we've seen some real good opportunity in that, especially in the smaller garden space, because it's all old vintage anyway, right? So gutting it down and redoing it brings it back up.
Yeah, we're not repurposing. We don't. It's not something that we would do. We would do personally. Maybe it's something down the line we would look at doing, maybe a JV or something. But we typically buy existing or land. So that's more kind of our bread and butter.
All right. Talk to us about your favorite property that's in the portfolio today. Where is it? Give us some of the characteristics of it, how you found it, where it came from. Just like really, really quickly explain what the property is, describe it, and the genesis and the closing, how it closed.
We bought 9 buildings in downtown Mesa in the Opportunity Zone before they announced that ASU was building an extension to their campus down there. It's all on the frontage, right on the light rail. Old office stuff that had been there since the 40s. Very cool old buildings. So we probably got 120,000 square feet down there that we just picked up for pennies on the dollar. We're repurposing it all as bars and restaurants and you know, really cool kind of. And that's actually where we've got that one kind of launch pad working space that we have down there. But just repurposing old office into retail, and it's going to become a really cool walkable area with all these new students and people down there. And so we bought probably 40% of the downtown, and we're bringing it back to life, which is kind of the goal of the Opportunity Zone Fund to begin with.
Anthony?
Well, my personal, I guess, would be, I think it would be the biggest one that we've ever done. It was a $300 million portfolio. We 22 building, 2.2 million square foot portfolio that we bought from Honeywell pension plan. And so the backstory there was, it went online, I think in summer of 2015. Then we were part of the bidding process. We bid about 300 million, I believe it was. And we lost the bid, right? It was 320 million, I think was the highest bidder. They went with the highest bidder. So we lost the bid, we bowed out. Then a year in, the buyer, like through their due diligence, the buyer actually couldn't come up with the capital. So the whole deal fell through. So the whole deal came back online. And they went through the whole bidding process again, and they had to exit. Like they were like in their 2 1-year extensions, so they were getting like pretty close to their exit. Like they had to get out. But then the exact same thing happened. So the deal fell through again on the second time because the buyer couldn't come up with the cash. I mean, still, it's all, you needed about 150 million of equity, and it's quite a bit of money to raise, and they just it didn't come through. And finally, on the second year, after the second failed attempt, we actually got a call from the Honeywell pension plan saying, look, in the past, we heard you guys were interested. We know you bid. Is it still the case? We're like, well, yeah, but, not at your not at your valuations. And so he's like, okay, well, we're happy to do a deal at 295 million. So we got it at $5 million cheaper. 2 years later, at a higher occupancy, we got it at an 8 cap, and it really is like kind of our crown jewel in our portfolio because we talk about replacement value. I mean, you can't replace. It's an office park, right? Like you can't possibly replace this. So it's just like you can walk, and there's golf carts, like some of the. Like the EOs, like they'll drive within golf carts from office to office. There's people running in the park. There's deer. There's actually live deer animal, like within the beautiful asset. So it's Corporate Woods in Kansas City. Is anybody from the Midwest? I'm sure you guys would know it on the call. But yeah, gorgeous asset. I think that would be my favorite one.
All right. So we have 4 minutes left. I want to leave this open-ended for you guys. Just your closing remarks. What are your thoughts? How do people get in touch with you if they want to have a discussion about investing in your firms, and any closing remarks that you have? But please share with people how they can get in touch with you, and etc.
Sure. I don't really have any closing remarks. I think we're all sort of waiting to sort of see what's going to happen here. We're going to continue bringing in capital and preparing to invest that capital in what we hope is going to be sort of a downdraft. But people can reach me. I'm in Scottsdale. My phone number is 480-295-7800, or my email is john.hartman@caliberco.com.
Okay. Anthony?
Yeah, so just I guess to close off, I mean, we're always looking to grow our relationships. Again, the way we're structured as a co-investment group, we do look for like-minded partners to be able to acquire these deals together. So we provide the access to the deals, and together, we have the firepower to work together and to get access to deals that we otherwise wouldn't be able to buy alone. So we always look for the right type of partners. I mean, investors who are looking to access to these types of the same real estate deals as us. I'm always happy to share our deal flow and just to give you a sense of where we're looking next. Feel free to reach out to me at 51. I'm actually Montreal based, but our head office is in New York. But I'll give you my Montreal number, which is 514-758-8562, or just my email, which is anthony@grouprmcusa.com. And yeah, I'm super happy to have a chat and see if we could collaborate.
Sure. So with that said, I want to invite you guys to both register for this upcoming talk from the Federal Reserve Bank of Atlanta. Brian Bailey is a subject matter expert in commercial real estate. He advises the board on this space for the Southeast, and his work has been phenomenal throughout the pandemic. And some of the stuff we touched upon today will be covered also in this particular presentation that is coming up. I want to thank both of your companies for your involvement in FLAIA, and thank you for your time today. And I want to thank the audience as well. So we're going to go into our next presentation. You guys can drop in. And thank you, John. Thank you, Anthony, for coming on and sharing your insights today. It was an excellent.
Michael, thanks for having us.
Thanks, Michael, and thanks to everybody else. Thank you. Nice meeting you, John.
You too, Anthony. See ya.